Have you ever wondered how many entrepreneurs avoid paying taxes legally, even though they're making a ton of money? I always say if you're a real estate investor and you're paying taxes, you're doing something wrong. I love real estate. I own rental properties and I'll be acquiring more in the future. Why? Because the US tax code is built to highly favor entrepreneurs and business owners, and nobody gets more tax breaks than landlords and real estate investors. In today's video, I'm going to break down some of the strategies that real estate professionals need to be using to legally pay very little in income tax. The top 10 tax deductions for landlords and real estate investors. That's the topic of today's video on the other side of the break.
1877 Levy King, Levy Levy King, 1877 Levy King, levyking.com.
What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I've helped thousands of clients with unfiled returns, back taxes, tax liens, and that's right, IRS levies. If the IRS took your check, call the Levy King. I'll get it back. 1877 Levy King, levyking.com. I'm also the author of End the Tax Nightmare, Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Inside the book, I'll show you how to stop IRS levies, liens, and garnishments without paying the tax in full, how to set up the payment plan that you want and not the one that they want, and how to potentially settle your tax debt for less than you actually owe. My book has been a top seller on Amazon for years, and you can buy it right now for $19.99. But I want to give you a copy of the book absolutely free. Just go over to my website, endthetaxnightmare.com, and enter your name and email, and I'll send you a copy right away. No charge, not even for shipping. Totally free. Now, before we go any further with the video, I want you to take a moment to subscribe to our channel, and don't forget to like us on Facebook and follow us on Instagram. Okay, let's dive into today's content. Owning real estate is one of the best ways in America to gain wealth and financial freedom. Whether you have a long-term investment strategy with rentals or a short-term strategy with rehabs, real estate is hard to beat. The tax code allows you to legally write off so many of your business expenses that most real estate investors really should not be paying any income taxes at all. Unless you've been sleeping under a rock, you probably saw the recent headlines talking about how Donald Trump pays almost nothing in income taxes. These tax deductions and legal loopholes aren't just for billionaire investors. Small investors like you and I can take advantage of these exact same strategies to pay nothing in income taxes. The problem is that we don't know. We've never been told about some of these things. Well, let's dive in right now and take a look at some of these awesome opportunities. The number one way to reduce your taxes is through depreciation. Depreciation often allows real estate investors to make lots of money in reality, but somehow show paper losses every year at tax time. So they walk away with all this tax-free income. Here's a basic example to show you how this works. The IRS says that your property has a lifespan of 27 and a half years. This means that every year that goes by, your property becomes less and less valuable on paper, even though it becomes more and more valuable in real life. The reasoning is that renters will not take care of the property like owners will, and so over time, the property becomes worn out and eventually needs to be replaced. So if you have a property that's worth $275,000, you would depreciate it at $10,000 per year over 27 and a half years. This could put an extra $10,000 a year into your pocket. Depreciation is a big deal for real estate investors that could save you a lot of taxes. Number two is the 1031 exchange. The 1031 exchange allows you to trade in one piece of property for another property of like kind and thereby indefinitely defer taxes that would be due if you ever sold the property outright. Simple example. Let's say you bought an apartment building for $200,000 and it's now worth $600,000. If you sold it, you would owe capital gains on the $400,000 of profit you have in the building. At 15%, that's 60 grand due on the sale. But if you sell that building and buy another building, you can save the $60,000 in taxes. You can do this again and again, deferring taxes forever and increasing your wealth. Tip number 3 is the stepped up basis. The tax code allows you to pass properties down to your heirs on a reduced or tax-free basis. For example, if you owned $1 million property and you took advantage of all the depreciation strategies available to us as real estate investors, eventually the property may be completely depreciated and have a basis of $0, leaving the entire $1 million subject to capital gains taxes if you sold it. But if you leave the property to your spouse, upon your death, she can take the property at its $1 million fair market value, effectively wiping out the capital gains tax. Tip number 4 is the mortgage interest deduction. If you have a mortgage, you're paying mortgage interest. The IRS allows you to write off that mortgage interest against the income you derive from the property, thereby lowering your taxes. So as an example, if you made 40 grand in income from your rental properties, but you also paid 5,000 in mortgage expenses, once you deduct the 5,000, you're now only paying taxes on 35,000 in income instead of 40. The mortgage interest deduction is a huge benefit for the real estate investor because your tenant actually pays the mortgage, not you. So it's almost free money. Tip number 5 is becoming a qualified real estate professional, or QREP. This allows you to avoid something called the passive loss limitations rule when you want to use your real estate paper losses to offset other types of earned income. This right here is the big kahuna of tax tips for small to medium real estate investors. To become a QREP, the real estate needs to be your main activity. Basically, it needs to be your day job, and you need to spend at least 750 hours per year, quote unquote, doing real estate. Now, let's say you earned 20 grand in real estate income, but you had 30,000 in expenses, which produced a $10,000 loss on paper. If you're not a QREP, that $10,000 paper loss will be carried forward to other tax years. But if you are, that $10,000 loss can be used to reduce the tax on the $50,000 in income that your spouse earned from her job, or maybe income that you earned from a part-time job. If you're not a QREP, there are other limitations on your ability to use real estate losses to offset earned income. Drop a link below to let me know if that makes sense, or if you want me to do a video on this topic all by itself. Tip number 6 is cost segregation. When it comes to depreciation, a typical commercial property has a 39-year life cycle, and a residential property like an apartment building has a 27.5-year life cycle. Remember, the quicker you can depreciate something, the more of a tax benefit you get now. So using cost segregation, you can write off things like flooring, countertops, cabinets, etc. in a much shorter period of time. Each of these items of personal property depreciate over different periods of time. A roof might depreciate over 15 years. Carpet might be 5, maybe 10 for countertops. The bottom line here is that 80 to 90% of the building can be depreciated in the first 9 or 10 years instead of waiting 30 years like you would using a normal depreciation schedule. Drop me a comment if you want to learn more about cost segregation. This also could be a video all by itself. Tax tip number 7 is deferred appreciation. Unlike some other asset classes, with real estate, you don't pay any tax on the appreciation of the asset as long as you're holding the asset. In other words, even while your real estate is going up in value, you're not paying any taxes until you actually sell it for a profit. For example, if you own a property that you paid 100 grand for and 1 year later it's now worth 120, you've got $20,000 in appreciation. With real estate, you won't pay any taxes on that appreciation unless you actually sell the property. Compare this to a mutual fund, for example. If you have $100,000 in a mutual fund and the mutual fund increases to 125, you'll now owe taxes on that gain, whether or not you sell the shares. The same applies with interest earned on a CD, a bond, or a bank account. The downside to this benefit is that you can't easily access the money inside the real estate, which brings me to my next tip. Tip number 8 is the cash out refinance using a traditional mortgage or a HELOC, which stands for home equity line of credit. A HELOC allows you to access all of the accumulated equity in your property without actually realizing any income for tax purposes. Because a HELOC is a loan and loans are not income, you won't owe any tax on the cash that you pull out. For example, you bought an apartment building for $200,000. and now it's worth $600,000. To get the equity, you could either sell it or do a cash out refi. If you sold it, you would owe $60,000 in capital gains taxes. But if you do a refi and pull out the equity, that doesn't count as income, so it's not taxable. The best part is that the proceeds of the loan go to you, but the tenant actually pays the monthly mortgage via the rent check. Number 9 is the capital gains tax exclusion. Most of the tax tips in this video are for investment properties, but this one is for your primary residence. If you own your home and you live there for 2 out of the last 5 years, you can sell that property and make a profit of $250,000 if you're single and $500,000 if you're married, and owe no income tax on the sale. With any other investment, you would owe capital gains tax and potentially income tax at both the state and federal level. But real estate allows you to avoid those pesky tax bills. Now, you got to live somewhere. So if you simply own where you live, you can shelter up to $500,000 from income taxes. Simply amazing. Number 10 is travel, meals, and mileage. Some of my rental properties are close to my home, so I'll drive to go and visit the properties, drive the neighborhoods, meet with prospective tenants, etc. I keep track of the mileage and any other expenses when I'm doing those drives. Other properties are farther away, and I might fly in once or twice a year to inspect the property and meet with my property manager. If I fly in, I'll usually stay overnight, and I obviously have to eat while I'm there. All of these items, whether I'm flying or driving or staying in hotels, etc., are write-offs and help reduce my tax bill. Now, just for good measure, here's one more bonus tip. Rental income doesn't pay any self-employment tax. Those of us that are self-employed pay a 15.3% tax on the income we earn. But the income you earn from rental properties is not subject to that 15.3%. So there's that. Okay, guys, so there are some of the top tax tips available to real estate investors and landlords. I love real estate, and I'm a real estate investor myself, and I use many of these tips to help reduce my annual tax burden. Speaking of tax burdens, if you owe back taxes to the IRS or the state, I want you to know that there are special programs in place to help you get a fresh start and get out from under this tax debt. But how do you know if you qualify? No two cases are exactly alike, so how do you know exactly how much you can settle for? Well, I've created a free tool just to help you get qualified for a fresh start. Just head over to www.levyking.com or click the link below. Follow the prompts and answer a few simple questions, and my team and I will help you figure out your eligibility. That website again is levyking.com, or you can give us a call at 1-877-LEVY-KING. Well, guys, that's it for this week. Talk to you later.